So good morning friends. Earlier we have completed part 1 of our chapter 2 of central banking CIB optional series. Chapter 2 is all about the central bank functions. So I think up to currency issue and management we have done that function. Now our next point is the payment and settlement function. So we are one by one we are checking the functions of the central bank. Now we are on the payment and settlement system. This is largely payment and settlement system in all our economies is controlled by their central bank only. In our India case, it is RBI only. So brief history is there. Earlier coffee houses was there for doing the clearing function. Then it was replaced by the clearing houses in UK. Earlier credit fund transfer system like Gyro system was there, which was evolved out of the postal system that was in Europe it was there. So just you need to remember these keywords. Earlier copy houses were there, then Gyro system was there. So it was nothing but the payment and settlement system. Later on these are the recent evolved system like NEFT, RTGS, IMPS, UPI. These are all regulated by the RBI only. So I am you all aware of the NEP and RTGS. For RTGS minimum amount should be 2 lakh. NEP you can do of any amount. Then IMPS means nothing but the IMPS of that particular bank app you have to download for doing IMPS. For that account number IFSC code is required. And UPI is nothing but that for example Beam UPI it's different bank accounts on the basis of your mobile number you can fetch it and you can link with your account and you can do payments. That is UPI system. So all over I will tell these are all regulated by the RBI only. RBI having control over the payment and settlement system. So definitely RBI will be fully aware of the liquidity situation in the market. So this is all about payment and settlement function. So next function is the maintaining internal value of the currency. This is important function, maintaining internal value of the currency. Why it is required? Because internal value of currency means nothing but the value of currency means inflation or deflation. That is only indirectly it is talking about maintaining internal value of the currency. You can think about if for example large fluctuation in the money supply, I have written here large fluctuation in the money supply cause inflation or deflation which affect the different person differently. Rich, poor, middle class all will get affected. FD rate, petrol prices, income taxation same but petrol prices are high. Like that what I am telling here that inflation is rising. Nothing but it will create hole in the common man pocket. So they are doing more expenditure, but income tax exemption remains at the same level only. So money is going out from the packet more. So that is the effect of inflation. So it is very much necessary that how we need to control the money supply, that is the control the internal value of currency. So if you can think if for example money supply in the economy increase means it will definitely push the prices in the economy. It will increase the inflationary pressure in the economy. So you should not go beyond some stipulated level. Otherwise definitely it will hamper. You can think about the present situation. What was the petrol prices was there earlier 1 or 2 years and now how much the petrol prices is above 100 plus only. So definitely once petrol prices will increase, definitely the price of for example vada pav, it was earlier 10 rupees, now it is 25 rupees. You can think about the cylinder value. Earlier it was less, now it is above 1000, 1200 it is there. So definitely all prices will definitely increase. So it is very much important to maintain the value of our currency. That is in case of the inflation, that value of currency will be going down. You can think for example you was able to purchase petrol 1 liter petrol of 80 or 90 rupees. Now whether you can purchase same amount of petrol in that 80-90 rupees, no. That is why the value of currency has been decreased in inflation period. Now it has been decreased up to the 110 rupees you have to give, more rupees you have to give for the 1 liter petrol. Like this the value of currency has been decreased. So it is very much important to control or to maintain this internal value of currency. Then in Great Depression also Friedman and Schwartz, he told about the consequence of the fall in the money supply. He has explained in the Great Depression. These are especially Friedman and Schwartz is related to Great Depression only, and they have explained this. I will explain in our next separate video I have made on Great Depression and Asian economic crisis. There I will explain this point. So next point is that maintaining external value of a currency. First we'll understand what is meant by maintaining external value of a currency means what. Means is nothing but the value of our domestic currency with respect to the foreign currency. That is indirectly means the value of our 1 rupee with respect to the value of dollar. At present what is the rate? I think it is around 80 rupees. $1 is equivalent to 80 rupees. So why it is important to maintain the external value of currency? This is utmost important, and that is important function will be done by the RBI only. So maintaining in external value of currency means maintaining the value of rupee with respect to value of dollar. Okay. Now at present scenario you can consider. With that scenario only I will explain. This is a theory part, a brief history part. I will explain this one. In brief I will explain to you. Before that I will tell what is meant by external value of currency. You can think, see now Ukraine and Russia war was going on. So oil prices definitely has increased. So India is a country which is more dependent upon the crude oil. We are importing crude oil. For that we are paying in dollar, or our forex reserve is going because we are importing more crude oil. So it is creating pressure on our forex reserve. That is one point is there. So we are losing forex reserve. So our currency, that is rupee, is getting depreciating compared to dollar. One thing is that. Second thing is that you can think last 4-5 months FII that was flown out of our country to safe haven or the respective country because of the hawkish monetary policy implemented by the US economy or other economies. So what happened that FII was flown out of our currency get destabilized. The value of rupee compared to dollar depreciated lot, and because of that our import bill is costing us more. Our import will not stop. Whether crude oil import will stop? No. In that it is creating hell. Like already petrol prices, crude oil prices are more. In that war is going on, Ukraine Russia war. Because of that the cost has increased more because of the trade barriers, restriction on the movement of the goods. Because of that cost has increased. So inflation outside our economy, it is coming to our economy. So because we are not in position to maintain our currency with respect to dollar, because of that our import bill cost has been increased and balance of payment or trade deficit is creating. Because we are importing more, our export is less, so definitely our foreign exchange reserve is going out. We are not having that much foreign exchange reserve. So what RBI is having foreign exchange reserve, that will be utilized by the RBI to prevent our rupee from depreciation. So how much dollar RBI will put in the market? That will be because for contingency purpose this forex reserve will be utilized by the RBI. Because supply in the dollar in the economy has been reduced, so RBI will try to create more dollar in the economy, will say, by putting more dollar from their forex reserve and sucking the rupee from market. Like this way RBI will try to stabilize our external value of our currency with respect to dollar. So second thing is that implication, why RBI has to maintain this external value, because implication is huge. First implication was that the balance of payment crisis or trade deficit, because our import is more, so for that we require more foreign exchange and it is going out. First thing is that. So and in depreciation it will affect us more, because import cost definitely it will increase because of depreciation. You can think, for example, $1 was around 70 rupees earlier, 4, 5, 6 months back. Now it is 80 rupees. Earlier you are paying for $1 70 rupees. Now you are paying 80 rupees, 10 rupees more. Our reserves is going because of the depreciation. First point it is that. Second point is that, for example, foreign investors are there. See, you can consider, because their return also will get reduced if we will not maintain our external value of our currency. Their foreign it will means our rupee will depreciate more, means foreign investor will not come because they will get less return. You can think, for example, one investor came to India, he has invested $1,000 in our country. So you can consider the scenario 5 months back that $1 was their equivalent to 70 rupees. So he has invested $1,000, means 70,000 rupees he has invested our Indian economy. At say 8%, 9%, whatever you can, at 10% you consider. At 10% he has invested 70,000 rupees in economy. So how much he is getting on 70%? 7,000 rupees in the form of the interest rate. Now you can think, after 5-6 months he want to redeem, he want to do redemption of his investment. So now value of our rupee has been depreciated to 80 rupees. Now whatever 70 rupees he has invested in our economy, what will be his value in dollar terms at present? If you divide 70,000 by 80 rupees, definitely it will go below $1,000. So he has brought $1,000 per investment in economy, while redemption, how much he is getting? Below 1,000 only. So his return, and at the same time his return also, that investment will also get reduced. So why he will come? These are, so that's why our investor, whatever retail investor or foreign investor, they will not get attracted to our economy because of the not maintaining external value of our currency. This is one point. Second point is the Mexican crisis or Asian economic crisis. You can think, if you are not aware of that crisis, but one of the major reason behind that crisis was only that that economy was not able to manage their external value of their currency, means currency of that country with respect to dollar, with respect to foreign currency. They were not in position to manage that one, and because of that, that crisis has increased a lot. So these are the reasons why we need to maintain an external value of our currency. That Great Depression, Asian economic crisis, I will explain in separate video. So here I have explained some brief history regarding external value of currency. See, you can see 1870 to 1914. You can read in that what is the summary of that paragraph. I will explain you. From 1870 to 1914, because these are notes made by me only, so definitely I am having knowledge what I have written in that. Any point you can tell me, I will explain you, because this is the preparation which was done by me already. So that's why. So from 1870 to 1914, what was majority of our trade was based on the international standard based on gold. So trade was going based on the gold only at that time. So means countries having their own currency, but that was pegged to gold. For example, we can say, for example, $1 is equal to 10 gram gold. $1 is equal to 10 gram gold, and what we'll say, 1 rupees is equal to 1 gram gold. Deliberately I am keeping 1 rupees less, because that will be less, because dollar was stronger economy, stronger currency only. So $1 was 10 gram gold, and 1 rupee is equal to 1 gram gold. So like this currency was pegged to gold. So from this we can calculate that $1 is equal to how much rupee. Like this you can it is 0.1 only. So like this currency mutual rates also can be traced out from the gold. So what was the base? Actually base was the gold. Based on that gold, currency value has been determined. So but what was the rule of the game? Rule of the game was that how much gold reserve you are having, you can print that much amount of money only, because your currency has been pegged to that gold reserve. So in comparison to the gold reserve only, you have to create that money supply. Like I told, what $1 is equal to 10 gram, means that much. For example, 1000 gram means 1 kilo gold is there, means how much $100 you can print, like that. And that was condition. Definitely that condition was there. I mean, condition was there. So it was autocorrective. It was based on autocorrective mechanism because gold was there. How much gold you are having, that much only you need to print. So you cannot print recklessly. So like this, that system was there based on the gold. But in that, what was happened? A trade surplus country, the country which is having more exports than import, definitely they will have more stock of gold or more stock of US dollar. Like that, it was a problem. And what was happened? See, I have explained here. It was trade surplus country will have gold reserve. Then they will print more money. This will create inflationary pressure in the economy. That will decrease the export. Thus, reduce the gold reserve. Thus, it is autocorrective mechanism. Because see, for example, if we are doing if we are having more gold reserve, means you will print more money will create inflationary pressure in the economy. This will reduce your export. If export will reduce, means again gold reserve will deplete, so again money supply will decrease. So like this, it was autocorrective mechanism. What will happen? World war started. In world war, many economies was devastated, like Germany, it was devastated. Then heavy reparation was imposed on the other economies also. And definitely other economies which was involved in the war also, they also suffered, like UK was also suffered. So what was problem was that there are so many resources that was already wasted into the war. Now they were UK and other countries, European country become they are not having that sufficient gold reserve. But what mechanism was their monetary policy mechanism? They have to maintain their money supply as compared to their gold reserve only. But they were not in position to do that because gold reserve has been depleted in UK. So no more they were able to peg their currency to gold reserve. So I think in 19 close to, I don't remember exactly, but UK has abolished that linking of their currency with the gold. That international standard based on gold, they have abolished that. They told that we cannot able to manage it. And same situation in from 1929, I think in 1928, in that period only they have abolished it. From 1929, that Great Depression happened. Then US economy also jolted, they also suffered. And because that they also not in position from in 1930, 31, 32, in that situation they were also the same panic situation was there, recessionary situation was there, many resources was depleted because 1929 depression was affected whole world, especially US economy in an enormous amount, in a devastating way. Yeah. It was, I mean, one of the severe depression in the world because at that time, world GDP, overall world GDP fell by 15%. And compared to our global financial crisis that happened in 2008, world GDP fell by, I think, less than 1% only. I'm not telling this from Wikipedia, I read it. So you can just intensity of the Great Depression, you can just judge from it how severe that Great Depression was there. So US economy also abolished that international standard based on gold because they were also not able to manage, because that depression came, recession came, they need to create money supply, but because of the linking of this gold with their currency, they were not able to do it. So they also abolished this standard. So because of that, after in 1944, again efforts were made to re-establish that gold standard. So in 1944, I think in Bretton Woods conference was taken in Hampshire, New Hampshire, I think. That conference was taken, and there they have decided that now we need to bring back that international standard based on gold in new form. So international standard based on new form. So what they have decided that the money, now the currency all over country currency will be pegged to US dollar, and US dollar in terms will be pegged to gold only. So only one currency, that is only dollar, will be pegged to gold, and other currency will be pegged to the US dollar. So this decision was taken in a Bretton Woods conference. like IMF and World Bank. This also was created at that time. You know that in world history or economic history, 1945, these two big institution was created actually. So everything was going right until 1967 when the US economy was facing the balance of payment crisis. What happened? Because in the USA 1961 that Vietnam War also happened, and they were facing that import was more and export was very much less, because of that what trade imbalance was created. Moreover, unemployment situation was there in the US economy, so they want to take some decision to rejuvenate their economy. And what this was the burden, it was equivalent to burden for them to maintain their US dollar with the gold, and because other currency was also pegged to US dollar. So what was happening, that their import was less and export was their import was more and export was less. So the US dollar was flowing to other economies. Because of the heavy import, US dollar was flowing to other economies. What was happening, that other economies having more US dollar compared to US economy. So definitely US can dollar can be print against the gold only. How much gold they were having, against that only they can print. But now what was happening, US dollar was more in the world. So whenever any country is demanding gold against that US dollar, that USA was not in position to provide it. So this actually create the panic among the, or one signal in the world economy, that US is not in position now to maintain that US dollar linking of their dollar to gold, because gold reserve was depleted and more demand was coming for that gold, but USA was not in position to give that gold to other country. So because of that, now then finally it was decided in 1971 that Nixon shock was came in 1971. Nixon shock came means in the form of, like, they have decided that भाई हम लोगों से नहीं होने वाला ये, we are going to delink our US dollar with the gold. So that's why they have delink. You can read here. Nixon 1971 Nixon shock came, delinking gold and dollar, means dollar they are dealing with the gold. I mean, they will told that now dollar will not be linked to gold. Now dollar will be free flowing, means only now based on that metal, that currency will not flow. Means now fiat currency regime. This was actually the start of the fiat currency regime. Fiat currency regime means there was no backing of any metal like gold or silver, only currency. So only currency. So gold standard regime was collapsed and fiat regime started. So at that time only the Smithsonian agreement also came. It was agreement was done by I think 9 or 10 countries came together. They have decided that we will delink our currency with the gold, and there will be free flow movement of the currency with the band of 2.25 from the central rate as agreed by that group of 10 countries. Later on the fiat regime came, where free float of currency with other currency came. Means free floating of the currency with the band of 2.25 from the central band. That in that band only currency will move. Like that a Smithsonian agreement was done. This was asked in the exam, I think. The Smithsonian agreement in June, I think June 2022, some shift it was asked Smithsonian agreement. So what is that agreement? This one only 2.25 band, floating band from the central rate is agreed by a group of 10 countries. It was a Smithsonian agreement. So next point is that so this is all about the external value of our currency. 1.0 only I was explaining. Okay, so regulation and supervision and stability of the financial system. This is also one of the function of the central bank. So what is the ultimate objective? It's nothing but the safety of the public fund, maintaining financial stability. That is the objective. For that purpose, supervision and regulation of these banks, like RRBs you take, the cooperative bank you take, public sector bank or private sector bank, that has to be regularized, that watch and checks and balances should be kept on their activity, so that public money will remain safe. So I have written here like a supervision also required. At micro level it is required supervision like early warning signal, capital adequacy norm, asset classification, income recognition norm. These are the norms which are defined by the RBI. that norm bank should follow, so that if they overall this follow, them means NPA, bad asset of the bank, will not increase. Then at a macro level, some indicator like EP I have written. EP means employment, price stability, and interest rate. At macro level, bank RBI is supervising these indicators. Means how much employment generation has been done, how much what is the price stability, interest rate. At macro level, supervision, this terminology is required. At micro level, early warning signal, capital adequacy norms, whether bank is following. Early warning signal means SMA 0, SMA 1. These are like classification which is given by the RBI. These are early warning signal before asset is turning into bad asset. Because why RBI is performing this function? Because RBI in better position due to huge collection of data, control over payment and settlement system. They can understand well the liquidity situation in the economy. So they are in better position to control economy, supervise economy. That is required because it's public money which is at risk. So here I have written Camel's approach. Then we have shift to, means this is the approach, it was earlier there. Before Basel norms, Camel's approach was there. KC means capital adequacy. Then it is management, earning, liquidity, then supervisory, sensitivity. Like this full form is there. Camel approach was earlier there before Basel norm. Then risk-based approach came. Risk-based approach means you can think capital adequacy norm, credit-based risk, market risk, operational risk. Like this we have to keep aside some amount compared to this risk. Weightage is given. You can you have already read in the BFM paper, explain very well capital adequacy norms. I will also explain in a subsequent chapter. This concept will come. Basel norms, I will separate video I will made on Basel 1, Basel 2, Basel 3. Don't worry about it. In that we will discuss this Camel approach and risk-based approach. Now in short you just remember it. Then financial stability is one of the function, not separately. I have just defined why I like this definition, that's why I have written. It can be asked who has defined financial stability in this way. So Mishkin, this name you remember, Mishkin, he has defined the prevalence of the financial system which is able to ensure in a lasting way without any major disruption, efficient allocation of the saving to investment opportunity. So system which is devoid of any major disruption and major allocation of this saving, means saving is mostly going to the productive sector of the economy in the form of loans. Like that he explained. Y.V. Reddy, he has also, Mr. Y.V. Reddy, I think he was also governor, he has also explained financial stability means set to exist. He told if financial system is characterized by the uninterrupted financial transaction, absence of higher volatility in the market, maintain level of confidence in financial system and among all stakeholders. I think both are definition good, but I find Y.V. Reddy's definition more precise or more practical to our economy or overall world economy. Yes, it is fully defined. I find it fully defined. So Y.V. Reddy, he told absence of higher volatility. Higher volatility should not be there. If higher volatility is there in the market, means investor confidence will reduce. They will not think that at one moment they will think they will gain, on another moment will be huge loss. That should not happen. Uninterrupted financial transaction, like our payment and settlement system should be intact. There should not be any crisis happen. Like this. Then promotional function to support growth. This is one of the objective of the RBI, that proportional function. Actually after Great Depression this function was specifically given by the government to RBI. What? Because RBI, what exactly RBI is doing? RBI or central bank, they are controlling banks, they are controlling credit creation in the economy, they are controlling money supply in the economy through supervising regulation of the banks, because ultimately bank which are giving loans. So there definitely the monetary policy will help to create employment, price stability or interest. These three were the major objective. This is also one of the objective of the central bank. Employment creation, growth, this is also one of the objective of the central bank. Then to control the inflation in the economy. Then priority sector targets. These are also function. Priority sector targets are set by the RBI only, so that the money should flow to the what will get economy disadvantaged section of the our society, so that they will also flourish. Financial inclusion will happen. Here Phillips score is written. Phillips score I will explain in separate slide also. It is just inflation and it is Phillips wants to tell that inflation and growth in a short term it is beneficial for the economy. In long term, inflation is not good. That is only Phillips score. Then development of the financial institution and market. See, NABARD earlier was a part of actually RBI only. So NABARD was carved out of the RBI. So it was one of the department earlier in RBI, but later on how that function was increased. So NABARD was created out of the RBI only. So NABARD, then National Housing Bank, then IDBI, National Payment Corporation of India. These are all institutions which are created by the RBI only. What their function is mainly, you can think here their function is only the development of our economy, socio-economic development. Like for example NABARD, who's they are doing refinancing to whom? Commercial banks, just to provide this credit to agriculture sector, agriculture and rural development. These are the main function of the NABARD. So they are doing development of our economy. National Housing Bank for housing finance they are going. IDBI for industrial purpose. National Payment Corporation, overall payment system they are controlled by the NPCI. Then last function of the RBI is the communication policies. Through communication policy is nothing but annual report, monthly bulletin, RBI circular. These are all published by the RBI and they will place in public domain just to increase the transparency and to maintain their accountability to people also and to our legislature also. The communication policy is also one of the function of the central bank. So in this way, friends, we have completed our part 2 of the chapter 2 function of the central bank. So don't forget to like, share and subscribe our video. This will definitely give us motivation to me to make a next video. I am making all these central banking resources for you people only, so that you can focus on ABF and BFM more, and you within less period of time you can cover this central banking optional. And second thing is that this optional will remain in the next year onwards, because retail banking will not be there. So in that way also it will help you. So goodbye friends, take care.